Okay, we'll go ahead and get started. Thanks for attending, everybody. This is our first of what we hope will be many of these webinars to come, and the intent was to create a quarterly opportunity for us to get together and kind of review what's gone on over the past 3 or 4 months in the economy and the markets at kind of a high level, and talk a little bit about what the outlook is for the future as well. And then to where it's appropriate, share some, kind of practical planning tips and that kind of stuff. So really, that's going to be our agenda for the day for us to go through. Here we go. So yeah, we'll do a quarterly recap of the markets and the economy, an outlook for the future, talk a little bit about helpful tips, and then answer any questions. In the top right-hand portion of your screen, you should see a question mark. Everybody is on mute right now to keep the noise level down. But if you have questions throughout the presentation, you can enter the questions by clicking on that question mark and then just typing the questions. We'll see the questions here, and then we'll take the opportunity to answer those questions at the conclusion of the meeting. So we find that's a better way than just unmuting everybody and having a lot of folks, with feedback and with talking over each other. So if you have questions, you can enter them by clicking on the question mark throughout the presentation. So there are three of us, me, Chris Strong, our Director of Financial Planning, and Ashley Sheridan, one of our wealth advisors, and we'll be going through a brief agenda here talking about what's going on. I thought it would be helpful first to talk maybe a little bit about what's gone on in Washington over the last 24 to 48 hours, actually over the last 16 days. We all know that a deal got done yesterday. In our commentary that we sent out about 2 weeks ago, we noted that we thought, unless we missed our guess, that a deal would get done, and it would get done at the last minute, as is typical. That wasn't because we're clairvoyant. It's because we kind of have a keen eye for history. There have been 17 of these showdowns in Congress since the mid-1970s over the debt ceiling debate. 17 of them. And 17 of 17 times, they've come to an agreement before we defaulted on our debt. So it wasn't really a stretch to predict that they would come to an agreement before an actual default occurred. Of course, we would have liked it if they would have been able to do it without shutting the government down for 16 days. But in any event, that's where we find ourselves. The scope of the agreement, without getting into too much detail, was they agreed to reopen the government. They agreed to raise the debt ceiling on a temporary basis to give them about 3 months of breathing room. In exchange for that, they agreed to put together a bipartisan committee that will come to the table before December with a substantive, and that's their word, a substantive budget plan. For many of you, this may sound a little bit like the super committee that they put together, when was it, 2 years ago, Chris? A year and a half ago? They put together the quote-unquote super committee, and the only thing they did that was super was nothing at all. They were unable to come to any kind of agreement at all, and it was a dismal failure. I have little doubt that they will come to the table with any kind of a substantive budget reduction plan between now and the end of the year. Because there's just too much polarity and too much partisan bickering going on. So unfortunately, that's just the reality of it. I don't see it getting better. In terms of the effects going forward, we think it's probably going to be more of the same. Just the same old, same old. We doubt seriously that this was some kind of watershed event where everyone's going to suddenly start getting along and acting like adults in Washington. It's probably going to be more of the same. But in the meantime, the markets and the economy continue to trudge forward and advance, as I've always said, in spite of the activities of politicians. So that's just a quick recap. I would encourage people, though, to use this past 2 weeks as an object lesson about getting too fearful or too upset or behaving badly when it comes to investment decisions when this kind of stuff occurs, because as we see again, the likelihood that someone wants to be responsible for a debt default Republican or Democrat, wants to be labeled as being responsible for a default on U.S. debt would essentially put that political party out of business for a long, long, long time in terms of having any kind of authority at all. So, I really don't think if we go through this exercise again in a couple of months that, people should get too concerned about it. It's just the dance they do in Washington, and it will continue. But we would like to see, obviously, some kind of a solid debt reduction plan come to the table. So we'll continue to keep our fingers crossed for that. With that, I'm going to turn it over to Chris Drawn a little bit, and Chris is going to talk about what's gone on over the last quarter in terms of the markets and the economy. Chris?
All right, thank you, Jeff. As we can see, what I wanted to do is take a look at a few slides to walk through where we're at in the economy, some reasons why we think the economy will continue to show signs of growth, and then we're going to move into a recap of the markets. And so we all know the recovery has been slow, but it's also been resilient. And although voters remain disenchanted with Washington, after more than 3 years of growth and new peak levels of output, consumer sentiment has improved, and nationally housing prices are recovering. From an investing standpoint, the difference between a weak economy that is getting worse and one that is slowly improving is significant. As key elements of uncertainty have resolved, economic growth could therefore strengthen. As of the end of June, our economy was growing at a rate of 2.5%. And while that is not stellar growth, I think it is constructive to realize that our average growth rate over the past 20 years has been about 2.5%. So while this recovery has been slow and relatively weak in many pundits' minds, it's actually been rather average, to say the least. I think going forward, our expectations are for growth to maybe pick up slightly. There's a couple of reasons for that we'll get to in a second. But I think hopes of a 4 to 5% annual growth rate are simply unrealistic. The primary reason for that is as our population continues to age and retire, it's normal for the economy of developed nations to naturally become more moderate in nature. And with 10,000 baby boomers a day retiring over the next several years, our economy will have some headwinds there, and the biggest one is the shift in demographics. So I think slow but persistent moderate growth is where our expectations need to be.
Okay.
Here are some reasons for our optimism about the continued growth in the economy. It's hard to get hurt falling from the basement window, and as Warren Buffett and others have pointed out, many of the most cyclical parts of the economy, those that tend to contract faster in recessions and grow faster in a recovery, still have room to go. Because of this, the economy is less susceptible to another recession. Over time, pent-up demand for automobiles, housing, and inventory could actually help boost the economy and support a more robust recovery. As each of these charts show, we're either just now getting back to normal or on our way to getting back to normal levels, normal activity levels in the automobile industry, in the housing industry, and other big-ticket items.
Yeah, let me just jump in real quick too, Chris, right there. I mean, I think it's useful. I mean, I hate to use charts and graphs because I think for a lot of reasons it's difficult for people to translate what they mean. But if you just look at the charts on this page, on the top, on the bottom, I'm sorry, on the left side of the page and then the bottom, you can see the long-term averages for things like vehicle sales and housing starts and capital good orders. And that those long-term averages are useful in terms of forecasting where we are today. Are we in a peak or are we in a trough? And so it helps, I think, to a degree, to give you some sense of where we are in terms of the sectors kind of returning to those historical averages.
So really, what this translates into is another reason behind why we see improving finances, both in our pocketbooks as households, as well as at the federal level. So the chart on the left looks at household net worth, which is a sum of all of our assets, including our home equity values, which are beginning to rise in many places, minus our debts. And as net worth increases, households generally become more confident in their financial situations and begin to loosen up their purse strings. It's kind of like how you might feel if you happen to get a raise or come into some extra cash. You're likely to save, invest it, or perhaps go and spend it and receive a feeling of enjoyment from it. And that leads to consumer confidence, which is a self-fulfilling event, if you will. As we feel better about our financial situation, we tend to engage in the economy in a more productive way. The chart on the right tracks the yearly budget deficits since the 1990s. And I bet if you were to ask the average American if our national deficit, which is the amount of difference between our receipts and our expenses on an annual basis, if our national deficit has been increasing or decreasing lately, they're probably likely to tell you that it's been increasing. But in reality, the opposite's true. In fact, significant progress, whether we like the way it has come about or not, through the political bickering in Washington, significant progress in the reduction of our deficit has actually been taking place. In fact, for 2013, our deficit this year is half of what it was the prior year. And for this reason, as we can see on the chart, when we look forward to expect, will the deficit reduction continue or likely moderate, we can see that the biggest hurdles are behind us. And it's for that reason that we think the economy will likely pick up, in fact, in the quarters ahead. And that, the sequester, the reductions in the budget, all of that was a headwind for economic growth. But with it behind us, the likelihood for the economy not to deal with that, the possibility of enhanced growth, if you will, slightly more growth than what we've been experiencing with that headwind, should come about with the less of a budget deficit reduction underway.
Yeah, and just to tag on to that, one more thing to reinforce that, the reduction in the deficit is really for two reasons. One is higher than expected tax receipts and tax collections, and the other is that the sequester actually went through, and Congress finally did something right. They stuck to their guns. They stuck to a commitment that they had made to reduce spending, right? And the world didn't end, but the deficit declined. And that's a lesson we think people should take away from this, that that they have to continue to try to cut this spending to continue to reduce the deficit. Unfortunately, the Congressional Budget Office projects that deficit will start to grow again in future years because of the overwhelming growth we're going to see in Social Security and Medicare and Medicaid receipts. So, they can't pat themselves on the back for this stuff too much right now because they've got bigger challenges coming in terms of the deficit. They need to get their arms around it now, not later.
Yeah. And then finally, the last slide that I want to show on the economy is not meant to make your eyes go nuts, but rather to show an example of how the global economy is performing. And what this chart shows us is a heat map view of global manufacturing. Obviously, the red areas would connotate troubled times. The green areas would indicate good times. When it comes to manufacturing, there are indexes that we can track to see if growth is occurring, manufacturing is expanding, or is manufacturing contracting in each of these countries of the developed world. Any number above 50 is signs of positive expansion. Any number below 50 is signs of contraction. And so if we were to take a look at our poster child for contraction, i.e. Greece, through the financial recession, we can see that for Greece it got really red. along the way. But if we focus our attention on the last column of the right, we can see that many of these economies are showing signs of continued growth. They're pulling themselves out of the recession that they were in. And we see a trend occurring that would lead us to believe that these economies are strengthening and will continue to grow from the levels that they're at today. So I put this up to give us a global view of where the economy is at in case you haven't been following that. So things aren't as bad as they were a few years ago, and in fact, in Europe, much of their circumstances have improved, and we're beginning to see improvement in Asia as well. Okay, so now I'd like to turn our attention from the big picture economy to focusing on asset class returns. And this is one of our favorite charts. It shows us the performance of various types of assets over time on an annual basis. Basically, it reiterates the randomness of returns and makes the case for diversification. So far this year, U.S. stocks, both large and small, have led the markets higher with double-digit returns. Through September, small U.S. companies were up nearly 28%, while large U.S. companies were up over 19%. And if you had asked me at the beginning of the year if we would have experienced these levels of returns, I certainly would not have expected it. And as a result, I wouldn't advocate that we set our expectations to see them remain at these levels, even though we do expect the markets to continue to go up. Fixed income, things that pay us interest, emerging markets, and commodities so far have been the asset classes with negative returns this year. We're going to speak to fixed income here in a moment, but we're beginning to see some progress in emerging markets turn positive this year, and commodities are still having some struggles. Since all of our portfolios are diversified, I think it's important to understand how a diversified, a balanced portfolio would have performed so far this year, and that's indicated by the gray box. This is a portfolio of roughly 60% stocks, 40% bonds, and through the end of September, that type of portfolio is up somewhere around 9%. Now, your portfolio may be more or less than this, depending upon your specific application, but I think it's important to illustrate this because we all own diversified portfolios. We don't focus on one particular asset class, and if we're comparing our portfolio's returns or what we've earned year to date to just large U.S. companies, we could get a distorted view of really where we stand.
Right, and so if you look in the red box that Chris put on this slide, where you see year-to-date 2013 returns, the vast majority of our clients own all the colored boxes in some manner, in some amount. So your returns, when you get your quarterly reports, which went out yesterday, I think, in the mail, when you get them, you'll see a new report that we added to it, which shows the gains and losses on each one of your color-coded boxes on what you own. And so your returns are explained by the percentage of money you have in each one of these different boxes. And that kind of gives you an explanation of why your returns are what they are. But I would call your attention to one more thing on this slide, which is, I think, should be of interest to you. And that's the steadiness across the middle of the chart of a diversified portfolio. That in none of these circumstances do you find yourself riding along the bottom or riding along the top or experiencing a high degree of volatility. Because when you have a diversified portfolio, the whole objective is to keep you moving smoothly across the middle of the investment spectrum. And that's visually illustrated on this slide. So anything else there, Chris?
No, that's good. So why do we believe equities still have room to grow? I put together a few charts, despite Jeff's protest to demonstrate these, because I'm a chart kind of guy and he's not. But I don't want you to get too wrapped up in these. I just wanted to use them to tell a story of why I think we have room to go. The first chart on the left is a comparison of the earnings of large U.S. companies compared to the interest rate that you could get by lending money to a large U.S. company. And we can see on the right there that the two dots over time have been pretty much in line. In periods of recession, however, they widen. So we can see that we're coming out of that. And here at the very far right of that first chart, we can see them beginning to diverge again. And the reason why they're diverging is because the stock prices are rising. And we believe there's still room to bring those numbers together. The other way that they could converge back to running in tandem with one another is if interest rates were to go way up. And while we think rising interest rates are in front of us, I don't think they're going to go way up anytime soon. So the more likely scenario is that earnings of corporations will continue at their pace, at their record-setting pace, and stock prices will follow because stock prices are a reflection of profits. The second chart, the bottom left, is a review of how much debt U.S. companies have on their balance sheets. And the green dotted line shows the historical average rate, somewhere around 160% of the equity value of a company is what typically would be held in the amount of debt that they have. Through the recession, corporations have done a tremendous job, like many households, in reducing their debt. And going forward, there's plenty of room for their growth to continue and be financed through taking on responsible levels of debt, if you will. And as they do that, to fund their growth, to put factories in place, to expand product lines, that will all lead to continued growth in the economy, which will lead to rising equity prices. And then finally, on the right is a chart that tells us, are stocks cheap or are they expensive? And the line that goes across horizontally, anything above that line tells us that stocks were historically cheap during that period of time, and anything below that line tells us that they were expensive. And as we can see in 2008, where the trough of that chart shows us way below that dotted line, that would have told us that stocks were overpriced or expensive at that point in time. And then if we compare it to where we're at today, there's still room because stocks are relatively cheap given the historical valuation. And then finally, this chart, I put this in here to help answer the question, if we have rising interest rates, will stock prices go down as a result of that? If interest rates are going up in the economy because the cost of borrowing has increased or the economy is getting better, does that mean stock prices will fall? And the answer is no. What we see here is a historical account of the relationship between stocks going up and bond interest rates going up, or the interest rates in the economy. And when we've had interest rates below 5% in the past that have gone on to a higher level, stock prices have generally gone up. So the top left corner of that chart shows us that in similar periods where interest rates were very low, and we're in that period today, the 10-year government bond, if you own one of those, you're getting paid a paltry 2.6% for owning it. In low interest rates environment, when rates went up, stock prices went up with them. And it's somewhat intuitive to understand why. Interest rates are going up because the economy is getting better. And if the economy is getting better, that means people are working and companies are making money. And if companies are making money, stock prices follow profits, so they go up as well. So just because we enter a period of rising interest rates does not mean that our stock portfolios will decline in value. And so speaking of interest rates, we've had 30 years of interest rates declining. Some of you may remember the good old days when a CD at the bank paid us 12%, and today a CD for 1 year pays us maybe 0.5%. And so as interest rates have come down over the last 30 years, we've had the positive nature of rising bond values. If I own a bond that paid me 10%, and tomorrow interest rates are at 8%, the value of my bond or my bond mutual fund that happens to own it would be higher than the value of your bond that pays 8%, because I'm getting more cash flow. And so what we've seen over this period of time is interest rates have fallen. The value of bonds and bond mutual funds have gone up as a result of that function. In fact, over the last 20 years or so, bond funds have averaged a return of about 6% per year, with over half of that being attributed not to the interest payment that was earned, but the market value appreciation of the bond fund because of the declining interest rates. Now, the opposite of that math is also true. As interest rates go up, the value of my bond or bond mutual fund will decline in value. And so we've witnessed that so far this year. In fact, at the far right of that, we can see where the blue line begins to start ticking back up and to the right. A year ago, the interest that you would have earned if you had owned a 10-year government bond was around 1.4%. Today, the interest rate that you would earn by owning a 10-year government bond is around 2.6%. For every 1% that the interest rate goes up, the value of my bond declines by 9%. And that's what we're seeing this year. As the interest rates have risen, the value of bond funds have fallen, and that's the reason why fixed income assets are posting negative returns. Jeff, if I can get you to advance this slide.
Yeah.
So it's important to remember that when it comes to bonds, there are two sources of a return. There is the market value that I've just explained. As interest rates go up, bond values go down, vice versa. And then there is the interest payment itself that we receive. The two of those together give us the return that we get for the year. On the left of this slide, we have a number of different fixed income investments ranging from short-term, high-quality government bonds to longer-term bonds to corporate bonds, high-yield, floating rate, a variety of bonds, and their market value return through September. And we can see the magnitude that the third one down from the left, that's a 30-year government bond. The longer that maturity is, the more value is lost when interest rates go up. I believe the 30-year bond is down 14% or so. As we add to it the interest rate, the interest payment that we would receive by owning those bonds, we get to the total return. And that's the column on the far right. And there's only two fixed income assets with positive returns year to date. The first one is high yield bonds, and the second is floating rate banknotes. All other fixed income assets have a negative, slightly negative to a somewhat marginally negative return year to date. Going forward, we would expect fixed income investments to struggle to make positive returns. And for that reason, our investment philosophy leads us to invest only in short-term, high-quality bonds, those with a maturity that is very short. In fact, you would have seen very, very little decline in value year to date because of the short maturity schedule, as compared to owning other bond funds that tend to focus on intermediate to longer term bonds where returns are down 7 or 8%. Our bond funds are relatively unchanged.
Basically flat to maybe down 0.5%. And that's primarily, as Chris noted, we focus on very short term, 5 years or less, and very high quality. And you want to own some fixed income in your asset allocation simply because it helps serve as ballast in the boat. When the stock market gets rocky, people tend to flee to quality. And quality usually means high quality bonds, short term bonds. And so, that's our approach. Our approach is to keep everything short term on the fixed income side and keep it very high quality and take risk where risk is worth taking.
Yeah. And to that point, you may ask yourself, well, why don't we own the high yield bonds? They've had a positive return year to date. High yield bonds are also known through another name called junk bonds. And these are bonds that are held by non-investment grade corporations. They tend to behave like stocks. So if we're going to take risks like stocks, we're going to own stocks. We're not going to own these types of risks in our ballast, if you will, of the boat.
Yeah, in the bond portfolio. Good. Anything else, Chris, there?
No, so that's the end of mine. I'm going to turn it over now to Ashley, who's going to give us a look at some opportunities.
You there, Ashley?
Yes, I am.
Okay.
Can we hear me? Okay.
Yeah.
Okay. Well, we want to take a look at some of our outlook and opportunities. We know that D.C. is on most investors' minds right now, but we want to direct you towards things that are going on outside the U.S. There are many global opportunities out there that we want to make sure and capture. The size of the middle class in emerging markets has increased significantly recently. It's projected that the middle class is going to continue to grow and reach over 5 billion by 2025. And that's what this chart is just showing. So this represents a tremendous opportunity for investors as more people around the world will be buying goods and may even have more money to invest. The question to ask yourself is, in growing countries like China, India, Philippines, and Brazil, all countries where the middle class is growing, do you think that people will be buying more tennis shoes and Pampers, chicken nuggets over the next 20 years or less? The answer is pretty obvious, and companies like Procter & Gamble, Nike, and McDonald's know this and have been taking advantage of it. Europe and the emerging markets have also been improving, and we saw in Chris's earlier slide on global manufacturing. Their equity markets have followed suit. The chart on the right shows the amount of return needed to get back to their 2000 peak for the European and emerging markets. For example, the European markets are still 37% below their peak in 2007. That leaves a lot of room for growth, while Europe's countries have some real problems ahead of them, the companies headquartered there are doing a lot better because their markets are all over the world, not just in Europe. So another theme that we're also following is the expansion of our national energy production. Can you please?
There you go.
Okay, thank you. Okay. Our natural energy production that will have profound effects for years to come. So do you know the city that the arrow is pointing to? It's as bright as Minneapolis, nearly equal to Chicago, but nobody lives there. Surprise, it's the oil fields in South Dakota. The light that you see is the flaring of natural gas from the wells because it's cheaper to burn it than to transport and store it. The chart on the top right shows the production of natural gas here in the U.S. since 1990. With the advent of new technology in the mid-2000s, we've been able to extract energy from shale deposits at an increasing rate, and it's expected to continue. As a result, our imports of oil from other countries are on the decline, and the U.S. is getting closer and closer to becoming energy independent. On the bottom right, we can get an idea of how low our natural gas prices are compared to the rest of the world. At 276 per million BTUs, the U.S. is a very competitive manufacturer on the world stage. In fact, having relatively cheap energy prices is leading to insourcing. We're so used to outsourcing at this point, but the American companies are now opening factories and bringing production back home. So as far as oil is concerned, the U.S. is now the #1 producer of oil per day, more than Saudi Arabia. So we think energy, the exploration, production, distribution, and use of will be a major factor contributing to a sustainable economic expansion. So to recap, most economists are forecasting around a 3% growth rate for the next year. Not great, but not bad either. Unfortunately, it's not high enough to make a sizable dent in unemployment, so we expect that to remain in the 7% range for the year. Interest rates will likely continue to trend upwards, but at a slow pace. And as Chris discussed, equities continue to look favorably priced. Overseas, Europe is stabilizing. China has some potential bubbles in the real estate and debt markets that bear watching, and emerging markets will be a mixed bag, meaning that some will do well and some will not, which is typical.
Okay, great. Thanks, Ashley. Appreciate that. Okay, so in terms of just kind of talking real briefly about how we address some of the risks and the opportunities, I put together 3 questions to ask, and you know, you can kind of answer them in your head, but they are, you know, how comfortable are you that the U.S. economy is out of the woods, that you know, it's going to continue to grow and expand and prosper, and not going to you know, hit bumps in the road here and maybe slip back into recession? How comfortable are you that the politicians and the Fed can manage the debt burden and keep our dollar strong going forward? And then how comfortable are you that U.S. and global companies are going to continue to innovate and grow? Well, if you're like most people, your answers would be, well, I'm feeling better about the economy, but I certainly am not completely confident that we're out of the woods yet. I have little to no confidence in politicians and the Fed to manage much of anything. But I do believe that companies will continue to try to innovate and grow. If those are your answers to those questions, then the way that you should have your accounts, your money, your investments allocated is really through the approach that we have always embraced, which is this core and satellite type of approach to investing. And we call it a defensively opportunistic approach because you want to own a core portfolio of diversified assets across the planet for long-term growth. That means owning stocks and bonds that are globally based and holding on to them because we know over time they're going to give us the kinds of returns that we need. But in the interim period, so we don't take the you know, a roller coaster ride that we're not interested in, we want to surround that core portfolio with smaller investments, what we call satellite portfolios, that focus either on reducing risk, on tactical management, or on the opportunities that Ashley was referring to there. And the whole reason we do this is we're trying to reduce risk and increase returns, or the potential for returns in doing this. And so I'll show you an example of that right here. If you look at the 2 pies and focus on the pie on the left first, the 2 numbers underneath the pie are the returns on that pie since 1994, and then the standard deviation, or a measure of risk of owning that pie for that same time period. When you're looking at risk or standard deviation, high is bad and low is good. So we can see if we owned half our portfolio was just S&P 500, and then 15% was in global stocks, and 30% was in bonds, we've achieved an average return of 7.43% over that time period, and with a standard deviation of 10.8. But if we shift our gaze to the pie on the right, and we notice if we add in some other kinds of assets like commodities and other asset categories, what happens to our return is it goes up. And what happens to our risk is it declines. Anytime you can add an investment to your portfolio that increases the potential for return and decreases the potential for risk, you've made your portfolio more efficient. You've made it more efficient. You've created more efficiency in the portfolio. And that's what we try to do with this core and satellite portfolio approach. Okay, and referring back to this slide, that we talked about earlier, the way that you create kind of a smooth ride across the middle of the investment spectrum is not by speculating and not by hindsight quarterbacking that, gee, I wish I was 100% in stocks this year because I'd be up 20%. But in fact, by saying, I know that if I own a mix of all of these assets, two things are going to happen. I'm not going to make a killing, and I'm not going to get killed. And that's frankly what most people need, particularly those that are planning for a 20 or 30-year retirement, where they need to be able to harvest income off their retirements over a 20 or 30-year period. What you want is no panic and no euphoria. And that's what we try to create through this core and satellite portfolio structure. The last thing I will mention as kind of our closing thought for the quarter, and then we'll be happy to address a question or two that have been proposed, is that the media isn't your friend. The media, most people, understand this, I think, to a degree, but they lose sight of it a lot. The media is a business. The truth and the news are two different things. News programs like CNBC and Fox and MSNBC and Kramer and all these other television shows are in business to make money off advertising dollars. And the way that they get advertising dollars is by attracting eyeballs. And the way that they attract eyeballs is through sensationalism. And you could have seen this last night if you were watching CNBC when Congress voted to put this debt default debate to bed. All of a sudden, all the air went out of CNBC. They didn't have any more drama to propose. It was over with. So what they did is flashed a big sign up that said, America isn't out of the woods yet. Stay tuned. Right? And they're trying to get people, they're trying to flatten your perspective. When they do that, you have to tune in every 15 minutes. And when you tune in every 15 minutes, Procter & Gamble can try to sell you some more soap. And that's their business. That's what they do. So you've seen me kind of tongue-in-cheek in some of our past commentaries, and even our last commentary, recommend that instead of watching TV, you go out in the garden or help the kids or grandkids pick out Halloween costumes, because you're not really accomplishing anything by sitting down in front of Fox News. I mean, I would challenge you to tell me, when was the last time you sat down in front of Fox News for an hour and stood up feeling better about things than when you sat down? The answer is never, and that's by design. So take this last experience we've been through as a lesson the next time it occurs, and it's going to occur again. There's without a question it's going to occur again. But try and reflect back on this experience, because it'll help you, refrain from behaving badly when it comes to your investment portfolios. So with that, we're going to wrap up. We had a question posed, though, and again, any of you who have questions, simply just click on the top part of your on the question mark up there, and you can pose a question if you like. The question that we've had proposed was, will the Fed's policy to create unnaturally low interest rates lead to excessive interest rates in the future? Chris, you want to answer that?
Yeah, and that's a question on many people's minds, with the role that the Fed has had with the stock market or interest rates today. Undoubtedly, they have had an effect. The Federal Reserve has been the primary buyer of our government bonds on a weekly basis for the past few years. And what they're doing in buying those bonds is keeping the interest rates in the economy at a low level. And so the answer, or part of the question, is, are they artificial? Absolutely. Short-term interest rates are absolutely artificial. They are driven by the Federal Reserve. That is their purview. That is one of their two mandates, is to keep inflation low, to stimulate the economy. And they do that by buying and selling bonds. Will it have an effect on long-term interest rates? To some degree, I would suspect that it will. But I think the more appropriate influence of long-term interest rates is the overall general health of the economy. As we've seen this year, as the economy has improved, as balance sheets have improved, interest rates have begun to climb on longer-term government bonds. And that is the interest rate that drives all other longer-term bonds. So the price of borrowing money from your bank to either fund your business or put a mortgage on your house, the interest rates have been climbing. That rate is set by the market. It's less influenced by the Federal Reserve. And then the third thing that I would use to answer this question is, what effect will the Fed have when it comes to selling these bonds that they've put on their balance sheet over the past few years? That is the great question, and open right for conspiracy theories that we won't get into today. But there are mechanisms that the Federal Reserve does have available to get those bonds off their balance sheet. One is they could hold them until maturity and not worry about selling them back into the marketplace. That would have no effect on interest rates. The bonds would simply mature and it would be paid off. They could slow down on their purchases of bonds, and that's in fact what this tapering talk has been about. I would expect the tapering to continue for several years. It's not a turn off the spigot right away. So just because Ben Bernanke says we're going to reduce the amount that we're purchasing on a weekly basis does not mean the end of the world. It means that they are reducing the amount that they're purchasing. They're still purchasing quite a bit, but they're doing it at a slower rate. And I would continue to expect that for a couple of years, which means the short-term interest rates will remain low for some time. But that does not mean that long-term interest rates will have to remain low for a long time. And again, we're already seeing those go up.
Yep, good answer. Okay, folks, with that, we're going to close it out. Thank you for your time today. If you want to listen to a replay, we'll have it posted on the website pretty soon. Also, if you think it'd be useful to have others listen to it, you can refer anybody you'd like to the website, and they'll be able to just click on and listen to a replay of the webinar anytime in the future. We'll have these cataloged and archived on our reading room on the website. So with that, thank you again for your time, and we'll look forward to talking to you again next quarter. Bye-bye.